One of the biggest questions that I get asked as a professional real estate investor for someone that's new and really learning how to invest, like, Kris, how do I know if the deal I'm looking at is a good deal? Like, is there like a formula, or people talk about crunching numbers? Like, how do I know if I should buy the house or I shouldn't buy the house? How do I know if it's gonna make me a lot of money, a little money, or lose me money? In today's video, I'm gonna help you understand how you as a real estate investor evaluate deals to know what they're actually worth so that you know whether you should pull the trigger or not.
One shot, now the future before us, go!
All right, let's start by talking about how we don't make decisions. Kris, I found a really good deal and I think if I do it, I'm gonna make like some money. Let's call it $20,000. Like, should I do the deal? I'm like, okay. First of all, you don't make a decision on doing a deal based on how much money you think you can make. You do it based on something called an ROI. It stands for return on investment. And what it basically means is if you or a partner or someone lays out some cash, that's called the investment. And then the question is, what comes back to you? That is called the return on the investment. ROI. And in this video, I'm literally going to show you how to calculate ROI. It's not that hard. And if you want to make millions of dollars in real estate, you only need to know like this much math, like a couple of equations. This one is probably the most important. Now, the purpose of ROI is to determine how you compare different options to each other. So understand where most people are coming from when it comes to ROIs is they're saying, well, society told me to get a job after college and to put money into a 401k because I get an employer match. And so you might want to know, cool, you're doing that, but is it going to be enough for retirement? Do you even know what your ROI is? If you don't, I'm going to tell you right now, they just finished a 20-year longitudinal study and determined for the last 20 years that the average 401k here in 2024 is producing a 4.2% ROI. Now, just so you're also aware, inflation is sitting right around 4.1%. And if you don't know what that means, it means that you have money sitting in a 401k, and while it might be earning you 4.2%, that would be like, Kris, here's 100 grand in my 401k. If I earn 4.2% on it, that would be equivalent to $4,200 or 4.2% on my 100 grand. However, if inflation is 4.1%, then that $4,200 gets whittled back down to nothing because inflation is the rate at which we are losing buying power in our dollar. You could also take a look at an IRA or when people invest in the stock market. And when people usually blend their 401ks, ROIs, their stock portfolio, they're usually earning about a 6% average ROI. And when we compare that to real estate, you have to have a standard then on, well, if I'm gonna earn 6% there, Kris, what am I gonna earn on real estate that would make it worthwhile for me to move my money into real estate? Well, I'll share with you my standard. I never touch a deal unless I make every year what's called a 25% annual ROI or greater. And so you're thinking, okay, now I can compare apples to apples. That is the purpose of ROI. If I'm producing 6% in my retirement and I'm earning 25% in real estate, well, Kris, that's a difference of 19%. And the answer is kind of. You see, your money compounds in both of these vehicles. So let's just say for a moment that we got $50,000 sitting in a 401k or IRA earning 6%. In 20 years, this will become $160,000. But you see, if I'm putting this $50,000 as a down payment in my friend right here called real estate, earning at least 25%, then 50 grand earning 25% over that same 20 years doesn't triple like the 401k. It actually makes 27 times more money than the 401k. And that's because it's not just 19% more, it's 19% more that compounds every single year, which is why 90% of all millionaires made their money in real estate. When I calculate ROI on, let's say, a rental, meaning I'm gonna buy a property, I'm gonna have it rented out, and I wanna know, okay, I've got some cash that I'm gonna be putting out into this property to buy it, and my question today is, how much money is it gonna give me back? That is what ROI is. And in real estate, there are 3 different ROIs that we're gonna talk about today, and if you add all 3 of them up, they will give you your total ROI. The cool reason about why we have 3 is because real estate pays you in a number of different ways. So today we're gonna talk about number 1, cash on cash. That means I put money out and I rented out the property and I'm collecting leftover money every month after my rent that I collect pays all my expenses and my bills, and that's called a positive cash flow. And so you get that paid every month. So when you put money out and you get cash flow coming back, that's called a cash on cash ROI, because I'm laying cash out and then cash is coming back. And I want to know, of my total ROI, what percentage of that is a return on capital every month, or a cash on cash. The second kind of ROI that we're going to explore is what's called a principal reduction ROI. This is where I have outsourced my house getting paid off by my tenants. Every month that they live there, that they pay rent, a portion of that, as it goes to the bank, will pay the interest, and a portion will also pay down the principal. So what's interesting is there's an ROI on the principal reduction. Or in other words, the tenants are earning you an ROI on helping pay off that house. Because someday when you sell it, when you say, wow, look at all the money I made. Some of the money I made was from positive cash flow, my cash on cash, but some of the money I made was because the tenants were paying it off, and that also gave me an ROI. And the third ROI that we're going to discuss in this video is what's called appreciation. And that means that real estate nationwide goes up 4.65% year over year over year. Now, if I go into markets with a higher appreciation, I'm going to get a higher reward. But bottom line is, if I bought this house for $300,000, next year it might be worth $320,000. And in 10 years, it might be worth $480,000. So just by holding real estate is an amazing store of value, unlike the crappy US dollar. Because remember, this goes down 3 to 4% every year. Real estate goes up 4 to 5% every single year. So putting money in real estate compared to the dollar, like in your savings account or 401k, there's a delta of about 8 or 9%, which is a monstrous difference between holding cash and looking at the appreciation of an asset that is going up in value. That is the appreciation ROI. We're now going to explore how you calculate a cash on cash ROI, a principal reduction ROI, and an appreciation ROI, and add them all up and say, now I know my total ROI on my money going into this deal to see if it's worth it or not. All right, here we go. This is the house that we want to buy. It's not a toy house. It actually represents like a real big house that a person lives in. And what we're going to do right now is we're going to evaluate whether we should or shouldn't buy this house. Here's the scenario. We're going to start with number one, the cash on cash ROI. If I buy this home and it rents for $1,500 a month, but my mortgage and my expenses all come to $1,167 a month, then that means that I'm going to have leftovers of $333 every month of what's called a net positive cash flow. In other words, I'm collecting $1,500 a month, and after all of my $1,167 of bills going out every month, there's $333 left over. And because I'm going to rent it for a year, $333 of positive cash flow every month times 12 months equals $3,996. We're just going to call it $4,000. So now I want to calculate my ROI. To buy this house, I put $50,000 out as a down payment, and I'm collecting $4,000 back every single year as my positive cash flow. So here's how we calculate the ROI. We're going to take the gain, $4,000. We're going to divide it by my investment, $50,000, and then we're going to multiply it by 100. And literally pull out your phone and do this calculation with me. If I take a $4,000 gain divided by my $50,000 investment outlay and multiply that by 100, you get 8%. In other words, this house, if I buy it, is expected to produce around an 8% cash on cash return. Now, this is just one of the 3 ROIs, but I'm going to tell you that is a phenomenal cash on cash ROI. Let's see how we do on the other 2 ROIs. The second ROI is called principal reduction. Remember, I got tenants now living in this house, and every month they make their payments. I take some of that to pay the mortgage. And when I pay the mortgage, some of it goes to interest and a little bit of it goes to principal, which means every month I'm getting the house a little more paid off. When I someday sell the house, I will produce a return on investment on that money that is being used to pay it down. Now, the math is a little complicated because each house has what's called an amortization schedule. In other words, even though it's going to get paid off over 30 years, they're going to front load a lot of interest in the beginning payments, and then at the end, it'll be a lot of principal reduction. The safest thing that you can do on an investment property that is priced under $300,000 is make a safe assumption that your principal reduction coefficient comes out to 5%. So in this one, there's no math. If it's a $300,000 house and below, we're going to assume that by the tenants paying it down, that every year, year over year, I'm basically earning 5 additional % of ROI on the principal being reduced. By the way, this is cool because when you just compare your money sitting in a bank earning like less than 1%, that's not super exciting. And so one of my 3 ROIs just has the tenants paying it down over time and earning me an extra 5% each year on my money. That's kind of cool. And the third ROI is now called the appreciation ROI. And I'm going to tell you, this is always the biggest one. So unlike 401ks and IRAs in the stock market, you have purchased an asset that is rapidly appreciating in value, consistently for the most part. So let's assume that we bought this house for $200,000 and that in this particular market, we Googled it and it says, oh yeah, in this market, it's appreciating 5% every single year. So I do some math and I say, okay, well, what's $200,000, the value of the house, times 0.05%? Times 0.05% is equivalent to saying, what is 5% of $200,000? And your calculator is going to tell you that it's $10,000 a year. I'm like, okay, this is kind of interesting. This house is appreciating $10,000 this year, and then because next year it's worth $210,000, it'll appreciate even a little bit more than that the year after, and the year after that. So let's just be safe without compounding and assume that it only appreciated $10,000 every year for 5 years. I've got $10,000, 20, 30, 40. In 5 years, I've got $50,000 that the house has gone up. So it's no longer a $200,000 house, it's a $250,000 house. All right, we're on to our third ROI, and this is appreciation ROI, and it is the biggest of the 3 ROIs. And so let's assume that this house is worth $200,000. That's what we're considering buying it for. And it's in a market that is only appreciating at 3%. Now, mind you, the national average is like 4.65%. And I only invest in the top markets where I can sometimes get 8 or 10% or even more. But let's just be really conservative on this example and say that this market where you're buying it in only grows at 3% a year. So we're going to do some math. We're going to take our calculators. We're going to take $200,000, the value of the house. We're going to multiply it by 0.03. Why 0.03? Because that's how you express 3% in the calculator. So I put in $200,000 times 0.03 and it equals $6,000 of annual appreciation. So I'm like, whoa, I bought this house. I bought it at $200,000. The next year, it's going to be worth $206,000. So for the year, let's take a look at our ROI. So I've got my gain of $6,000. Now let's look at how we calculate ROI. We take the gain, like what we got back, divided by what we put in the investment, and we times it by 100. So in this case, this year, my gain is $6,000. And I'm going to divide it by my investment of $50,000. And then I'm going to multiply it by 100, which equals 12% ROI. Now, we're getting to that magic moment where we want to decide, Kris, do I do the deal or don't I? And remember, I don't touch deals unless I'm earning at least 25%. Let's add up our 3 ROIs and let's see if we got there. So here we go. My cash on cash ROI is 8%. My principal reduction ROI is 5% for a total of 13%. And then I have 12% appreciation ROI. Add it all together, it's a 25% total ROI. Kris, if I'm buying this home as a buy and hold and I'm going to rent it out, is this a deal you would do? Well, I have to make sure that I'm at least earning 25%. And then there's definitely a few other things that I want to check on. But for the most part, I've made my decision. Yes, I'm going to buy this house. When I'm deciding on whether I'm going to buy a property, I look at the ROI. But there's a few other things that I do want to look at. Am I buying it in the right market? Am I buying it on the right side of the railroad tracks? Have I really looked at what my vacancies and my repairs are going to be? There's a little bit more complexity to it. And if you'd like to get a game plan to have someone like me in your back pocket, making sure with each investment purchase that you're basically having me come in and guide you through the process step by step. If that's something that you want, you can request a free game plan from me and my team. It's basically where I'm going to jump into your shoes and say, all right, dude, if I were you, if I had your job or no job or your good credit or bad credit, doesn't matter to me. Like whatever you're at, wherever you're at, I'm going to basically say, what would I do to start investing in real estate right now? If you'd like to get a free game plan, or if you want to look at even potentially having me as your mentor, helping guide you through the entire process to build a real estate portfolio, or even have me do it for you, request a free game plan right now. Click the link below, just drop your contact information. Me and my team will be right in touch with you, and let's find out how long it's going to take for you to make millions of dollars and achieve your financial freedom. You know, per Redfin, 2 years ago, 27% of renters never thought they were going to buy a home. This year it's up to 40%. And I'm like, no, this is bad. Like, buying your first home is such an important choice in your overall financial future. I'm telling you right now that the next home you buy, or even if it's your first home, should not just be a place that you live in. It should be an investment property. And if you want to know what I mean by that, click right here, watch this video right now.